Have you ever seen this happen? You're looking at a company that is just firing on all cylinders, an absolute superstar, but its stock is getting hammered. It's a classic Wall Street puzzle, and today we're going to use e.l.f. Beauty as our case study to really dig in and figure out what's going on. All right, let's get into it. I mean, just look at this disconnect. It's a tale of two completely different companies. On one side, the business is an absolute monster. We're talking record growth, earnings that didn't just beat estimates, they doubled them, and they're just stealing market share. But then, you look at the stock, and it's like a horror movie. Down over 30% in just a few weeks, analysts are getting cold feet. What in the world is happening here?
So to cut through all the noise and the panic, we're going to bring in the big guns. We're going to apply a framework from a true legend, the one and only Peter Lynch, to see if we can get to the bottom of this. Is this a broken stock or a broken company?
And it all comes back to this one simple but incredibly powerful idea from Lynch. You have to understand what's really going on under the hood. It's not just about the ticker symbol, it's about the business. This is going to be our guiding light for this whole analysis. Now, the secret weapon in Lynch's toolkit was something called the PEG ratio. It's this brilliant little metric that connects the stock's price to how fast the company is actually growing. For Lynch, the magic number was 1. If you could find a stock with a PEG of 1, you had a bargain. But if it started creeping up towards 2, it was probably time to sell. This is absolutely key.
So, all right, moment of truth. Let's run the numbers for e.l.f. right now. You've got its price to earnings ratio, you've got its projected growth. You put them together, and what do you get?
The number we get is 1.57. Now, what does that tell us in the world of Peter Lynch? Well, it's not a sell, but it is certainly not the screaming bargain he was famous for finding. It's sitting right in that middle ground. It's fairly valued. But, the story doesn't stop there.
See, Lynch was like a detective. He looked for other clues, and he would have spotted a few red flags here. For one, the company took on a bunch of debt for a big acquisition. 2, if you strip out that new purchase, the growth of their main brand has slowed way down. And 3, almost everybody who's gonna buy this stock, all the big Wall Street funds, they already own it. The party's kind of full. So let's add it all up on our scorecard. Yep, it's still a fast grower, check. But the PEG ratio is just, okay. The debt, a little too high for Lynch, and it's way over-owned. So what's the verdict? Peter Lynch would probably look at this and say, it's a hold. He'd tell you to put it on your watch list and maybe get really interested if the price dropped to around $45. That's where the PEG ratio would hit his magic number of 1.0.
Okay, so the analysis tells us to wait for a better price. But what if we could turn that waiting time into a strategy itself? What if there was a way to actually get paid while we patiently wait for that perfect entry point to come to us? This is the classic investor's dilemma, right? You found a fantastic company. You love the story, but the price is just not right. The market won't give you the deal you want. So what do? Well, the strategy comes down to drawing a line in the sand. You're basically telling the market, listen, I'm ready to buy this amazing growth brand, but only on my terms. I'm only buying it if you give it to me at a price that makes it look like some boring old utility company. And believe it or not, there's a way to do that. The tool for the job is an options contract, specifically something called a cash-secured put. Don't worry, it's way simpler than it sounds. Step 1, you pick that perfect Lynch-approved price of $45. Step 2, you sell a contract that basically says, I am willing and able to buy the stock at that price. And here's the best part. Step 3, just for making that promise, the market pays you cash right up front.
Okay, let's get into the nitty-gritty, because this is where the strategy goes from a neat idea to something really compelling. Let's break down the actual numbers.
So here's how it works. To promise to buy 100 shares at $45, you have to set aside $4,500 as collateral. You're just proving you're good for it. In return for that promise, the market pays you a premium, let's say $630. So, what kind of return is that on your cash? Right off the bat, that is a 14% return on your money. Instantly. That's cash in your pocket today, just for being willing to buy a great company at the price you wanted anyway. But it gets even better. When you annualize that, it comes out to a 17.6% return. Think about that for a second. It's like you're renting out your cash, and the interest rate you're getting is over 17% a year. And just to put that number in perspective, let's see how it stacks up. The historical average return for the entire S&P 500 is about 10%. This single, patient strategy has the potential to absolutely crush the market's average return. You're not just playing along. You're setting yourself up to win by waiting.
Okay, I know what you're thinking, but what's the catch? What if the stock really does crash and I get stuck buying it at 45? Well, this is the most beautiful part of the whole strategy. This is where the safety net appears. Remember that $630 premium the market paid you? That's yours to keep no matter what. So your actual real cost to buy the stock isn't $45. You subtract the premium and your net cost basis is just $38.70. You end up owning this amazing company at a massive discount, a price even lower than what Peter Lynch would have considered a bargain.
Now, look, no strategy is perfect. There's no such thing as a free lunch on Wall Street. So it's really important we're honest about the trade-offs and the things you need to watch out for here.
First, you're making a long-term commitment. A lot can happen in 290 days, and beauty trends can be fickle. Second, there's opportunity cost. Your cash is tied up, earning that 17.6%, which is great, but you could miss out on some other stock that just goes to the moon. And finally, real-world problems like tariffs or a continued slowdown could hurt the business and make that future price look less attractive.
And all of this leads to one final crucial question that you have to answer for yourself. What's your real endgame here? Is your goal just to collect that fantastic income, hoping the stock stays high so you can do this over and over again? Or is the ultimate prize to actually have the stock fall to your price so you can get assigned and finally own this great company at a deep discount? It's a fundamental choice between being an income generator or a long-term owner, and that's a question every investor has to answer for themselves.